Think you're ready to take control of your finances? Let's start with a quick quiz to see where you stand on saving and investing. Which of these is the best for short-term financial goals, like an emergency fund or a vacation? The answer is savings account. Savings accounts are low risk and easy to access, making them ideal for short-term goals. Next one, is the statement true or false? Can you make investing completely risk-free by picking the right stocks? The answer is false. Investing always carries some risk, even with careful stock selection. Next question, which option is more suitable for growing your wealth over time? The answer is stock market. Over the long term, stocks have historically outperformed other options, though they do come with more risk. How did you score? Now that we've warmed up with some basics, let's dive deeper into saving and investing strategies that can work for you. If you love feeling secure with your money but still want to grow it, you need to know the difference between saving and investing. Let's dive in. Saving is all about short-term goals and emergencies. Think of saving as your financial safety net. It's low risk or no risk, perfect for a rainy day or just-in-case moments and those occasional expenses. Now investing, that's for growing your wealth over time. It's like giving your money a gym membership. It works out, builds muscle, and grows stronger over time. It comes with higher risks but also the potential for higher rewards. Imagine turning today's money into tomorrow's fortune. Savings accounts offer lower returns and often don't keep up with inflation, but investing in stocks or real estate can help protect and even boost your purchasing power. Remember, savings are liquid. You can access them quickly. Investments, they might take a bit longer to convert into cash, especially in retirement accounts. So what's the takeaway? Use saving for security and short-term goals. Use investing for growth and long-term dreams. The real magic, knowing how to balance both. Ready to take action? Let's explore how these strategies can benefit you, regardless of where you're starting on your financial journey. Let's find the best ways to save. First, regular savings accounts, a simple, easy-to-use option with low returns. Next, high-yield savings accounts. These offer better returns than regular savings accounts, making your money grow faster while still being accessible. Current accounts offer anytime withdrawal for immediate cash needs, perfect for businesses. But keep in mind, they typically provide no interest. Then we have Treasury bills or T-bills. These are short-term investments issued by the government. They are like a loan you give to the government, and they pay you back with a bit of interest. T-bill usually last from a few weeks up to a year, making them perfect if you want your money back soon. The best part, they are super safe. Since they are backed by the government, the risk of losing money is very low. Here's how it works. You buy T-bills at a discount, which means you pay less than their face value. When they mature, you get the full amount back. The difference is your profit. It's not a huge return, but it's steady and reliable. So if you are a conservative investor or just want a safe spot to park your cash for a bit, then T-bills can be your new best friend. Heard of peer-to-peer lending or P2P? Picture this. Instead of saving money in a bank, you lend your money directly to people who need it. Sounds intriguing, right? Here's how it works. Online platforms connect borrowers and investors, making the process smooth and efficient. Borrowers get faster approval and potentially lower interest rate. Meanwhile, you, the investor, can enjoy returns higher than a savings account. But wait, there's a catch. Since loans are unsecured, there's a risk. If borrowers default, you could lose your money, so it's crucial to do your research and diversify your investments. To research peer-to-peer lending platforms, consider these key steps. Evaluate platform reputation. Look up user reviews. Understand borrower vetting process. Reliable platforms perform credit checks and have stringent borrower screening processes. Assess risk management. Look for platforms that offer risk management features, like provision funds to cover losses from borrower defaults. Read terms and conditions carefully. Review the platform's terms regarding fund withdrawals, minimum investments, and loan default handling. Lastly, examine regulatory compliance. Check if the platform is registered with financial regulatory authorities. With careful research, you can make informed decisions about P2P platforms that align with your risk tolerance and investment goals. Next up, invoice discounting. It's a financing solution where you fund a company's unpaid invoices. You essentially buy these invoices at a discount. When the company's customer pay up, you pocket the difference as profit. Why consider invoice discounting? For starters, the returns can be pretty attractive, often higher than what you get from traditional savings or bonds. Plus, the cash flows are usually predictable. It's also a pretty secured lending as the invoice serves as a collateral. But let's keep it real, there are risks involved. If the company's customer delay payment or default, your returns could take a hit. Other risks include dilution risk, fraud risk, and legal risks where a company gets into a legal dispute with a customer. That's why savvy investors diversify across different invoices or partner with platforms that vet companies and access credit risks. In a nutshell, if you're looking for short-term investments with decent returns and can handle a bit of risk, invoice discounting might just be your next smart move. Wondering when savings options make sense? Here are common situations where saving is the best strategy. First, for short-term goals, when you need the funds within 1 to 2 years, savings is the best option. Whether it's for a vacation, wedding, or a home down payment. Building an emergency fund is essential. When you need quick access to cash for unexpected expenses like medical bills or car repairs, savings accounts provide easy access. Saving is also ideal for preserving funds for a known future expense, like paying taxes, insurance premiums, or saving for a large purchase. If you're risk-averse or nearing retirement, a low-risk savings account helps avoid market fluctuations and keeps your money safe. If you don't have the time or knowledge to manage investments, saving options are simpler and require less effort. For small amounts of money, saving is often the better option since the potential returns from investing may not justify the effort and risk. Businesses often use savings or money market accounts to manage short-term cash flow, covering operational expenses and emergency funds. During economic uncertainty or recession, saving protects your capital from market volatility, making it a safer option. As you can see, the emphasis is on safety, liquidity, and capital preservation rather than growth, which is why saving is chosen over investing. While saving is a crucial step towards financial security, it's often not enough to achieve long-term wealth. By transitioning from a saving mindset to an investing mindset, you can unlock the power of compounding and take control of your financial future. Cultivating a mindset for investing. Investing is more than just putting your money somewhere and hoping for the best. It requires certain characteristics that set investors apart from savers. First, investing has a long-term focus. Understand that real wealth is built over years, even decades. Investors also have risk tolerance. They accept that markets fluctuate and are willing to take calculated risks for greater rewards. They are always looking for growth. Investors seek opportunities to grow their money, often through stocks, real estate, or other assets that appreciate over time. A key strategy for investors is diversification. They spread their money across different investments to balance risk and reward. Investors are future-oriented, often with extra disposable income that they can afford to set aside for future growth. They are willing to accept delayed gratification. Investors know that real wealth is built over time, not overnight. Investors plan for inflation, making sure their money grows faster than rising prices, so they don't lose purchasing power over time. Investors are prepared to handle losses. They understand that downturns are part of the process and keep their focus on long-term growth. Finally, investors are optimistic about the future. They believe that over time, economies grow and their investments will pay off. With this mindset, let's look at the top 7 investment options for wealth accumulation. We'll dedicate a full video for this topic, but here's a preview of the assets we will cover. First up is stocks. Over the long term, they consistently deliver higher returns compared to other asset classes. Next, there's bonds. Bonds are essential for balancing your portfolio. Think of them as the anchor that keeps your ship steady during turbulent times. Third, we talk about mutual funds. Mutual funds pool money from many investors to invest in a diversified portfolio. Perfect for those who prefer a hands-off approach to investing. Number 4, we have ETFs or exchange-traded funds. ETFs are similar to mutual funds, but they are traded on the stock exchange like individual stocks. They come with flexibility and usually come with lower fees. Next, let's dig into gold. Gold has been a trusted store of value for centuries. It acts as a hedge against inflation and currency fluctuation. While it doesn't generate income, it's a great way to preserve wealth. Real estate is another cornerstone for long-term wealth accumulation. Investing in property can provide rental income and potential for appreciation. Lastly, cryptocurrency. Crypto is the new kid on the block, and it's been making waves. While it's a very high-risk, high-reward investment, it has the potential for significant gains. Just remember, only invest what you can afford to lose. A well-balanced portfolio might include a mix of these asset classes, tailored to your risk tolerance and investment horizon. The goal is to create a diversified and balanced portfolio that can weather different market conditions and grow over time. We will cover how to allocate these assets for long-term wealth accumulation. So don't forget to hit that subscribe button and stay tuned for more in-depth investing tips. Thanks for watching and happy investing.